What up, guys? My name is Roger and welcome to my channel. Today I'd like to be talking about why investors lose money. So here, if we go to my portfolio, we can see all the holdings I'm currently either getting money from or losing money on. As you can see, I am currently down the most here on Alibaba, and I'm losing some on Facebook, and I believe those are the only two holdings that I am currently down on. So here, if we go in this article I prepared that I found online, if we talk about the Peter Lynch's fund, the Magellan Fund, it's one of the best performing funds in history. It says that given that you would expect investors in this fund that made substantial returns over that period, however, what Fidelity Investments found is that people had actually lost money. So, if you don't know, Peter Lynch ran the Magellan Fund for, I believe, 13 years and averaged an annual return of 29%. So, the average return of the S&P 500 is roughly 10%. So, he nearly tripled the average market return for 13 years. But the average person, about the average person in the investing in the portfolio, actually lost money. But the answer is simple. The reason that most people lost money is because of psychology. People can't handle it. When they see themselves losing money, they get scared. And this happens all the time. We see it in the stock market. When the stock market goes down, people sell out. When the stock market keeps going up, people start buying in. We can compare this to my portfolio with Alibaba. At one point, I was down 30% in my holding. As you can see, at one point, Alibaba was trading at about a $310 per share, and has gone down so far to about $112 per share. And when I started buying Alibaba, it was roughly $200 a share. So let's go back here to my activity. We can see when I started buying Alibaba. Let's see, where do we go to find this? So we're going to my portfolio history. We'll go to my portfolio history and then search for Alibaba. And I started buying just a small amount. It looks like $167 a share. And since then, I've made several big purchases, 142, and my most recent is at $128 a share. And I was able to get a couple buys in near the bottom at $114 a share. But what it shows is that if we're able to control our emotions during times of turmoil, there's been a lot of bad news about Alibaba, specific ADR concerns, China regulation. There's a lot of concerns, but what we have to do as investors is try to weed through all the commotion, all the emotions, all the news. If you were to read the news and look at the news, you would think that the world's on fire over there in China, but that is not the case. When I find myself looking at a situation like this, I have to question myself whether or not I did my research. Whenever Alibaba has fallen and fallen again, or any company for that matter, I have to double check myself. I have to do my research and make sure that I'm making the right decision. So what I do is I go over to a website and then I recheck the research. How much is Alibaba growing? Is it growing? Is it decreasing its revenue? Is it increasing its revenue over time? Is it doing better? Is it doing worse? So I got here its revenue trend over time, and it is absolutely phenomenal. growing year over year, every single year, without falter. This company is doing amazing. It's one of the best charts that I've seen that a company has been able to do with growing its revenue. Even if we compare it to a company like Microsoft, where it's growing its revenue, on average, over the last 5 years or so, Alibaba is doing a much better job at growing its revenue than even a great and wonderful company as Microsoft has been growing its revenue. But it's because of all the fear, uncertainty, and doubt. Now, I will say that one of my main reasons, I have done a lot of research on the company, looking at its cash debt, its assets and liabilities. There's been the not only the double down but triple down by one of the legendary investors, Charlie Munger. So if we go over here and look at its assets, $267 billion worth of assets. Liabilities, not even $100 billion. More than double the assets than liabilities. Cash on hand, roughly $77 billion worth of cash. So it can almost pay down every single bit of its liabilities just with the cash it currently has on hand. If it wanted to pay down all his debt, it only has $20 billion worth of long-term debt at this time. So I say that say this, as investors, we must be able to weather the good times and the bad times. There are times in the market where fear is going to happen, and the value of a company is its future cash flow. So what we need to do as investors is recheck our situation, is make sure that did we do our due diligence? Did we look at the numbers and see if the drop in the price is if it's warranted? Because us as investors need to be able to know whether or not what we try to do is basically buy $1 for 60 cents or whatever the number is. Because what we're trying to do, as Warren Buffett says, is rule number 1 is not to lose money, and rule number 2 is to go by rule number 1. Never forget rule number 1. We're here to make money. And just because the stock goes down does not mean it's a bad thing. It is a good thing indeed that we want to be buying when things are going down. So that's my thoughts. If you guys like this content, like, comment, share, subscribe. Thank you and have a nice day.